What is happening, crypto champions? Get ready to dive headfirst into the absolute latest and greatest in the world of digital assets. The news cycle is absolutely on fire, and we've got the hottest updates that you simply cannot afford to miss. From bold business strategies to market-moving analysis, this is your essential download for what's shaping the future. We're talking about game-changing moves that are setting the pace, and you're going to want to be in the know. Are you ready to stay ahead of the curve? Then buckle up, because the Bitcoin Bulletin is starting right now. First up, we're exploring how a popular food chain is making a massive statement by doubling down on Bitcoin, not just as a payment option, but as a core strategy to navigate the choppy waters of traditional finance. This isn't just about innovation. It's a bold declaration of faith in a decentralized future, and it's sparking conversations everywhere. What does this mean for mainstream adoption and the very definition of business in the digital age? We break it all down. Then, we're shifting gears to dissect the intricate dance of the market itself. Prepare for an in-depth look at the forces shaping Bitcoin's price trajectory, including the often misunderstood influence of major holders and how the market weathers inevitable bumps in the road. Understanding these dynamics is crucial for anyone looking to navigate this exciting space, and we've got the insights you need. Next, we're heading into the high-tech world of mining operations. Discover how cutting-edge advancements, particularly in artificial intelligence, are creating unexpected opportunities and driving new growth for the companies at the forefront of digital asset production. It's a fascinating intersection of technologies that's redefining an entire industry. And finally, we're zooming out to get a broader perspective on Bitcoin's role in the modern financial landscape. Experts are weighing in on how Bitcoin is being viewed as a critical tool for safeguarding wealth against the erosive effects of inflation and economic instability. This is the kind of forward-thinking analysis that keeps you informed and empowered. Don't miss a single second of this packed episode. Hit that subscribe button, ring the notification bell, and let's get started. A shawarma chain's bold Bitcoin bet. This Canadian eatery is making waves by embracing Bitcoin as a core financial strategy. In a significant move that underscores the growing acceptance of digital assets in traditional business, Tahini's, a popular Canadian shawarma chain, has been actively accumulating Bitcoin since August 2020. This isn't a fleeting trend for the company. It's a deliberate strategy rooted in a desire to hedge against the perceived risks of fiat currency devaluation and inflation. The founders, the Hammam brothers, Omar, Ali, and Ahmed, who established the business in 2012, began integrating Bitcoin into their financial planning during the economic uncertainty sparked by the global pandemic. This decision was made even as prominent figures like Warren Buffett have voiced strong skepticism, famously labeling Bitcoin as rat poison. The Hammam brothers' conviction in Bitcoin aligns with a broader corporate movement, with entities like MicroStrategy and Tesla also increasing their Bitcoin holdings during a similar period. They view Bitcoin not merely as a speculative asset, but as a crucial tool for capital preservation in an era of quantitative easing and expansive monetary policies. Their commitment extends beyond mere investment. Ali Hammam has actively advocated for greater adoption, even suggesting to Canada's House of Commons Finance Committee that the government consider Bitcoin as legal tender and make a substantial investment in the cryptocurrency. This proactive stance highlights a deep belief in Bitcoin's potential to reshape financial systems. Tahini's has further cemented its Bitcoin standard identity by accepting Bitcoin as a payment method at select locations and installing Bitcoin ATMs within its restaurants. While the company maintains confidentiality regarding its exact Bitcoin reserves, it regularly announces new acquisitions on social media platforms, signaling its ongoing commitment. The chain's strategic expansion continues, with a recent announcement on September 2, 2024, detailing the opening of its 65th restaurant alongside the highly anticipated launch of its first U.S. location. This simultaneous expansion and continued Bitcoin accumulation demonstrate a cohesive, long-term vision that integrates digital currency into the very fabric of its growth. The company's proactive integration of Bitcoin into both its investment portfolio and customer-facing payment systems positions it as a trailblazer in the fast casual dining sector. This unique approach has reportedly been a significant factor in supporting its impressive expansion across Canada and its foray into the United States market. While Tahini's remains tight-lipped about the precise volume of Bitcoin it holds, citing a need to protect its long-term strategy from market speculation. Its public allegiance to Bitcoin resonates with prevailing macroeconomic trends and the increasing diversification of corporate treasuries into digital assets. But is this bold strategy sustainable in the face of market volatility? Next, we'll explore how Bitcoin is being positioned as a vital hedge against the looming economic shifts of 2025. Bitcoin as a Treasury hedge for 2025. As economic forecasts for 2025 indicate potential fiat devaluation, Bitcoin emerges as a strategic corporate treasury asset. The global economic landscape is constantly evolving, and as we look towards 2025, many businesses are reevaluating their treasury management strategies to mitigate risks associated with inflation and currency depreciation. In this context, Bitcoin is increasingly being recognized not just as a speculative digital asset, but as a viable, long-term hedge against the erosion of fiat currency value. This perspective is gaining traction among forward-thinking corporations that are seeking to diversify their reserves and protect their purchasing power in an environment marked by significant monetary policy shifts and geopolitical uncertainties. The core argument for Bitcoin as a treasury asset rests on its inherent scarcity, decentralized nature, and its performance during periods of economic instability. Unlike fiat currencies, which can be subject to inflationary pressures through central bank policies like quantitative easing, Bitcoin's supply is capped at 21 million coins. This fixed supply makes it resistant to the kind of debasement that can devalue traditional monetary assets over time. As governments continue to inject liquidity into economies, concerns about inflation are mounting, pushing companies to seek alternative stores of value. Furthermore, the increasing institutional adoption of Bitcoin, evidenced by companies adding it to their balance sheets, signals a growing confidence in its potential to act as a digital gold. This trend is not merely about diversification. It's about strategically positioning corporate treasuries to benefit from the potential appreciation of Bitcoin while simultaneously hedging against the devaluation of traditional currencies. The narrative around Bitcoin as a hedge against fiat decline is becoming more pronounced as economic indicators point towards continued inflationary pressures and potential currency volatility in the coming years. Analysts suggest that companies holding significant reserves in fiat currencies are exposed to a substantial risk of losing purchasing power. By allocating a portion of their treasury to Bitcoin, these organizations can potentially offset these losses and even benefit from Bitcoin's price appreciation. This strategic allocation requires a long-term view, acknowledging Bitcoin's inherent price volatility, but emphasizing its potential as a superior store of value compared to traditional, inflation-prone currencies. The conversation around Bitcoin as a treasury asset is evolving from a niche concept to a mainstream financial strategy. As more companies explore and adopt this approach, it is likely to further solidify Bitcoin's role in the global financial system, offering a compelling alternative for wealth preservation in an increasingly uncertain economic climate. But how are market forces and major players influencing Bitcoin's price path? Prepare for an in-depth look at the whale, activity, and market corrections that are shaping Bitcoin's journey. Navigating Bitcoin's climb, whales and volatility. Market corrections and the influence of large holders are key factors in Bitcoin's ascent toward the $150,000 mark. Bitcoin's journey towards significant price milestones, such as $150,000, is a complex narrative often influenced by powerful market dynamics, including the actions of major holders, commonly referred to as whales, and the inevitable market corrections that test its resilience. Understanding these forces is crucial for grasping the full picture of Bitcoin's price discovery and its potential future trajectory. While the long-term outlook remains bullish for many, the path is rarely a straight line, often characterized by periods of rapid ascent followed by sharp pullbacks. Whale activity, referring to individuals or entities holding substantial amounts of Bitcoin, can significantly impact market sentiment and price action. When these large holders decide to buy or sell, their transactions can create ripple effects throughout the market. A large sell-off, for instance, can trigger panic selling among smaller investors, leading to a price drop. Conversely, coordinated buying by whales can drive prices upward, creating a bull run. Their decisions are often closely watched and analyzed by traders and investors seeking to anticipate market movements. The concentration of wealth among a relatively small number of holders means their collective actions carry considerable weight, making their behavior a critical indicator of market health and direction. Market corrections are a natural and healthy part of any asset's life cycle, and Bitcoin is no exception. These periods of price decline, often triggered by profit-taking, shifts in market sentiment, or external economic factors, serve to reset valuations and can weed out over-leveraged positions. While uncomfortable for investors experiencing them, corrections can also present buying opportunities for those with a long-term perspective. The ability of Bitcoin to recover from these downturns and resume its upward trend is often seen as a sign of its underlying strength and growing adoption. Analysts often point to on-chain data and trading volumes to gauge the impact of whale activity and the severity of corrections. Tools that track the movement of large amounts of Bitcoin can provide insights into potential shifts in market control. Furthermore, the resilience shown by Bitcoin following significant price drops, often recovering and surpassing previous highs, reinforces its narrative as a robust asset capable of weathering significant volatility. The upcoming period is expected to be particularly dynamic, with analysts closely monitoring how these whale movements and potential corrections will shape Bitcoin's path toward ambitious price targets. The interplay between large-scale holders and market volatility is a constant feature of the Bitcoin landscape. Successfully navigating these dynamics requires a deep understanding of market psychology, technical analysis, and a firm conviction in the long-term value proposition of the asset. But what about the companies directly involved in creating Bitcoin? We'll dive into how AI is supercharging the stocks of Bitcoin miners. AI boom fuels Bitcoin miner stocks to record highs. J.P. Morgan highlights how advancements in artificial intelligence are driving unprecedented growth in the stock valuations of publicly traded Bitcoin miners. In a notable development for the cryptocurrency mining sector, J.P. Morgan analysts have reported that the market capitalization of leading publicly traded Bitcoin miners reached a record high in August, soaring past $39 billion. This surge is largely attributed to a strategic pivot by several of these companies into the burgeoning field of high-performance computing, HPC, particularly for artificial intelligence, AI applications. This diversification represents a significant evolution for an industry traditionally focused solely on the energy-intensive process of mining digital currencies. The increasing difficulty and cost associated with Bitcoin mining, exacerbated by the halving event that reduced block rewards, have put pressure on miner profitability. Consequently, many mining companies have been compelled to seek alternative revenue streams to cover operational expenses and maintain growth. The venture into AI data centers and HPC services has emerged as a key strategy, leveraging their existing infrastructure and expertise in managing large-scale computing operations. While the transition requires adapting facilities for more complex cooling and power management systems compared to standard Bitcoin mining, the potential rewards are substantial. Companies like Hut 8 have announced ambitious plans to develop significant new capacity across multiple U.S. sites, dedicating these facilities to non-mining purposes, including AI infrastructure. This strategic move aims to capitalize on the immense demand for computing power driven by AI development. Similarly, Hive Digital Technologies, through its dual business model combining Bitcoin mining with HPC services, is positioning itself to benefit from the growth in both rapidly expanding digital industries. Hive's CFO, Darcy Daubaras, emphasized that their approach scales Bitcoin production, while their HPC division provides a complementary revenue stream that grows with demand for compute power. However, not all industry players are fully embracing this diversification. Compass Mining's Chief Revenue Officer, CJ Burnett, expressed a more cautious outlook, suggesting it is premature to fully commit to HPC given the speculative nature of its long-term demand. Compass remains focused on optimizing Bitcoin mining infrastructure, viewing HPC as a potential future opportunity rather than a current necessity. This divergence in strategy highlights the different approaches within the mining industry as it navigates the evolving technological landscape. Despite the challenges and differing strategic views, the trend of miners expanding into AI-related services is clear. This diversification not only bolsters their financial resilience, but also positions them at the forefront of technological innovation, bridging the gap between cryptocurrency operations and the rapidly advancing world of artificial intelligence. The market's positive reaction, as reflected in the record stock valuations, underscores the perceived value and future potential of this strategic shift. But what does this mean for Bitcoin's broader role in the financial world? We'll explore expert views on Bitcoin as a hedge against Fiat's decline. And that's a wrap on today's Essential Crypto Briefing. We saw a Canadian shawarma chain go all in on Bitcoin as a hedge against inflation. Then, we broke down how Bitcoin is being viewed as a crucial treasury asset for 2025. We also analyzed the market forces, including whale activity, impacting Bitcoin's price potential. Finally, we uncovered how AI is driving Bitcoin miners' stocks to record highs. Stay ahead of the curve with Bitcoin Bulletin. If you found this information valuable, do us a huge favor. Smash that like button, subscribe to the channel for all your daily crypto updates, and ring that notification bell so you never miss a beat. Connect with us on all our social platforms to keep the conversation going. Thanks for watching, and we'll see you in the next one.